Hey everyone, this is Research on Investments, and today's topic is Synopsys, and we'll discuss how it's impacting all sectors and how it plays a big role in driving innovation. Before going any further, I would like to mention that it takes a lot of efforts to create these videos. For example, it takes me around 20 to 30 hours each. So if you find them helpful, please consider supporting this channel by subscribing or giving a thumbs up. It would mean a lot. Thank you. So let's dive in. Later in this video, I will be discussing why I believe Synopsys is one of the best AI chip stock for long-term investment. Synopsys is the largest electronic design automation or EDA company in the world. EDA is a heavily concentrated market with only three major players: Synopsys, Cadence Design, and Siemens. Some of the reason why Synopsys is a good long-term investment, and here are some of the overview. The company benefits from AI boom. It has strong financials. It is a market leader, and it is trying to become even bigger by acquiring Ansys. Some of the other risks is acquisition risk, geopolitical risk, and which we will discuss later in the video. Here are some of the topics that we will be discussing in this video. First on the list is earnings. In the most recent quarter, Synopsys saw a revenue growth come in at 24.5% year over year, closing out a year in which revenue grew 15%. Synopsys paired the strong top-line growth with significant margin expansion, with non-GAAP earnings growing 66% year over year to 3.17 cents per share. Both the revenue and non-GAAP EPS came just slightly ahead of management guidance. Synopsys has historically chosen to utilize free cash flow to pay down stock. Synopsys has a strong financial position. The company shows a healthy balance sheet with $1.59 billion in cash and only $18 million in debt. However, with this upcoming acquisition of Ansys, might increase the debt and leverage ratio. Also, it has a strong revenue growth forecast. Management expects revenue to reach 1.66 billion in quarter one, which is 22% year over year growth, and 6.63 billion for the full year guidance, which is 13.5% year over year growth. Also, the seasonal revenue fluctuation, which was due to the IP segment's seasonality. Also, the higher quarter revenue forecast reflects that the design IP segments seasonally typically performing better in the first half of the year. The company is expected to grow revenue of approximately 1.64 billion, aligning closely with the management guidance, and non-GAAP earnings are projected to be around $3.41 per share. During the conference call, management highlighted that they closed 2023 with a non-canceled backlog amounting to 8.6 billion. Unlike many tech companies, Synopsys does not reveal metrics like remaining performance obligation, which are commonly used to forecast future revenue growth. Consequently, some investors may interpret that 21% year-over-year growth in backlog as potential sign that revenue growth could accelerate to around 20% in the coming years. However, it is worth noting that the backlog only increased by 2.9% year over year in 2022 due to customers opting for smaller deals, suggesting that the robust backlog performance in 2023 might partly reflect a normalization of this trend. While management hint that their guidance might be conservative due to pessimistic outlook on their China operation, I would advise investors against speculating on the earnings report. Consensus estimate for stock has generally been accurate in the past, with recent revenue being relatively modest. It is important to highlight that unlike chip manufacturers such as NVIDIA, which Synopsys refers to as a customers, Synopsys business is less susceptible to cyclical fluctuations. As a result, the company may not necessarily benefit from growing trend of generative AI to the same extent. It's important to highlight that unlike chip manufacturers such as NVIDIA, which Synopsys refers to as a customer, Synopsys business is less susceptible to cyclical fluctuations. As a result, the company may not necessarily benefit from growing trend of generative AI to the same extent. Synopsys revenue is most closely linked to the expansion of workforce at semiconductor companies rather than the volume of chips sold. Let's go over Synopsys' biggest risks. Synopsys announced that they are planning to acquire Ansys for $35 billion. Ansys is a market leader in physics simulation and analysis software for designers of chip for cars, aerospace, defense, and industrial equipment. At the earliest, Synopsys' acquisition of Ansys is expected to close in the first half of 2025. I believe it is important to mention and go over this large acquisition because this acquisition will expand Synopsys' total addressable market going forward. At the same time, there are some risks involved in this acquisition. This will subject to Ansys shareholders and regulators' approval. So Synopsys' biggest risk is that it is planned acquisition of Ansys for $35 billion. This acquisition will expand Synopsys' total addressable market, but it comes with integration risk and high acquisition premium of 35% over Ansys' 60-day volume weighted average price. As you can tell, this acquisition is not cheap at all. This acquisition will only make sense if it increased Synopsys' total addressable market, revenue growth, and operating income growth by a lot going forward. Here's the important question we should consider. How will Synopsys fund this deal? Synopsys is planning to pay $197 in cash and 0.345 shares of common stock per Ansys shares. After the acquisition is completed, Ansys shareholder will own about 16.5% of the combined company, while Synopsys shareholders will own about 83.5% of the combined company. From this, you already know they will need to issue a lot of shares going forward. And here's another risk we have to consider. Other than issuing more shares, Synopsys needs to have $19 billion cash to fund this acquisition. Since Synopsys does not have enough cash to fund this acquisition, so Synopsys is planning to borrow $16 billion of additional debt to fund this acquisition. This means Synopsys total debt will be much higher for at least first 2 years after acquiring Ansys. After acquiring Ansys, Synopsys debt to adjusted EBITDA will increase to around 3.9 times from the current debt to EBITDA of 0.41. Synopsys expects that it can pay down its debt after acquiring Ansys, so the combined company debt to adjusted EBITDA is expected to be around 2 times or less post-closing. Over the long term, Synopsys expects that the combined company's debt to adjusted EBITDA will drop back to less than 1. Considering the current financial data and the acquisition of Ansys, I believe it may realistically take Synopsys more than 2 years to decrease its debt to adjusted EBITDA ratio to less than 2 times. Here's the reason. As of the time of this analysis, both companies have EBITDA of approximately $2.38 billion, and their combined free cash flow stands around $2.14 billion. Currently, after completing this acquisition, the combined company is expected to have a total debt of at least $16 billion. Given these figures, if it appears challenging for Synopsys to achieve a debt to adjusted EBITDA ratio of around 2 times or less within the just 2 years post-acquisition. Therefore, from a realistic standpoint, it seems likely that Synopsys require more than. Therefore, from a realistic standpoint, it seems like Synopsys will require more time to reduce its debt to EBITDA ratio to below 2. Currently, there's an ongoing semiconductor rivalry between the US and China. This geopolitical risk affects all leading-edge semiconductor companies, including NVIDIA, AMD, Intel, not just Synopsys. The US has implemented numerous export restrictions to inhibit China's access to most advanced semiconductor technology and tools from US companies as well as from allies like Japan and the Netherlands. From this instance, the US restricts companies like NVIDIA and AMD from selling their most advanced AI GPUs to China. The US aims to prevent China from achieving chip sovereignty, particularly in the realms of AI and advanced chip manufacturing. Synopsys is among the top 3 leading EDA companies globally, offering the most advanced EDA software utilized by major chip designers and foundries. EDA software plays a crucial role in developing the most sophisticated chips. Without appropriate EDA software, designing and manufacturing chips become extremely challenging. Whether it's Samsung Foundry or Intel Foundry, these companies rely on Synopsys EDA software and tools for chip design, simulation, and verification to ensure the chip functions as intended. According to Synopsys Financial, China remains a significant market, accounting for approximately 15% of the company's total revenue in 2023. If tension regarding chip technology continue to escalate between US and China, there's a possibility that US could technically prohibit EDA companies like Synopsys and Cadence Design Systems from selling their EDA software and tools to China customers. Based on the latest annual report, I personally don't anticipate US imposing a complete ban on Synopsys selling EDA software to China customers. Instead, it seems more likely that US may restrict Synopsys from providing the most advanced software that could enable China to develop cutting-edge chips, particularly those incorporating upcoming technologies like all-around transistors. Synopsys management has indicated that based on their understanding, it expects to have less impact on their business. Now let's talk about Synopsys' long-term growth prospects. First, let's delve into Synopsys revenue breakdown by categories. Generally, 63% of Synopsys total revenue comes from EDA or electronic design automation software and tools. 26% is derived from chips design IPs, which is intellectual properties, and the remaining revenue originates from software integrity services. Approximately 80% of these revenues are recurring, which is a key factor that distinguishes Synopsys' business model from cyclical nature often observed within semiconductor industry. This recurring revenue stream provides a level of stability to Synopsys' financial performance. Synopsys stands as a dominant force in the market and technology landscape, specializing in EDA, which accounts for approximately 2/3 of its sales. Additionally, the company's design IP segment contributes a quarter of its sales, supplemented by a smaller software integrity business. The EDA and IP sectors, crucial to advancing electronic innovation, plays pivotal role in the foundry, semiconductor, and electrical system markets, which are significantly larger than just the initial design phase. Investment in these sectors are vital to propel to the next wave of innovation driven by major trends benefiting various sectors such as data centers, networking, 5G, automation, AR, memory, and industrial automation, and among others. Synopsys offers comprehensive software and system solution within these domains. It is a prominent role in the EDA sector, encompassing these tools and technology for designing chip, semiconductor, and system, and underscores its strategic positioning. Another significant aspect of Synopsys business is its extensive profile of intellectual properties or IPs. These IPs are instrumental in chip design, verification, and manufacturing processes. From my understanding, all these major semiconductors have high-tech companies relying on these IPs from Synopsys for designing and verifying their chips. This positions Synopsys with a substantial competitive advantage in the industry. With the design IP market, Synopsys holds the second largest position, following ARM's holding. Cadence Design System ranks as the third largest player in the design IPs market. This highlights Synopsys' prominent position and competitive standing in the industry, particularly in the realm of design IP. Let's dive into the acquisition and find out why Synopsys is willing to pay a very large premium to acquire Ansys. As mentioned previously, it would be logical for Synopsys to acquire Ansys at a 35% premium. If this move significantly expands Synopsys' total addressable market, boosts revenue growth, and substantially increase potential income growth in the future. As mentioned previously, it would be logical for Synopsys to acquire Ansys at a 35% premium if this move significantly expands Synopsys' total addressable market, boosts revenue growth, and substantially increase operating income growth in the future. As mentioned in their presentation, following the acquisition of Ansys, Synopsys anticipates that its total addressable market, or TAM, will expand by 50% to reach $28 billion. This growth is projected to occur at a compound annual growth rate, or CAGR, of 11% moving forward. After the acquisition of Ansys, Synopsys' combined annual growth is projected to reach $8 billion or more based on the total revenue of both companies in 2023. Synopsys aims to realize $400 million in cost synergies by third year and $400 million in revenue synergies by fourth year post-acquisition. Over the long term, Synopsys acquisition growing its revenue synergies from $400 million to approximately $1 billion annually following the integration of an Ansys. Regarding margins, Synopsys expects that the combined company operating margin and free cash flow will see an uptick. This expectation seems reasonable as Ansys typically maintains slightly higher operating and free cash flow margin compared to Synopsys in most years. It's important to note that these financial projections are merely forecasts. Only time will ascertain whether Synopsys can realize these projected cost and revenue synergies. If Synopsys successfully achieves these synergies and expands its total addressable market slightly, then the decision to pay a substantial premium for acquiring Ansys will appear justifiable. In terms of long-term growth prospects, I foresee several trends that will substantially benefit Synopsys moving forward. First, Synopsys primarily consists of semiconductor giants like NVIDIA, AMD, Intel, Qualcomm, TSM, and Semiconductor Foundry. Regardless of the semiconductor industry cyclical nature, these companies will persistently rely on Synopsys EDA software and designs IPs for chip design. Beyond traditional semiconductor firms, numerous hyperscale cloud providers and high-tech enterprise are venturing into custom design development to maintain their competitive edge. These companies aim to stay at the forefront of AI advancements, including breakthroughs like artificial general intelligence or AGI. For instance, these tech titans like Amazon, Microsoft, and Google are developing their proprietary AI chips. Even Tesla is forging ahead with its AI chip for the Dojo supercomputer project. From my understanding, all these entities will need Synopsys EDA software and IPs for chips design and verification processes. This positions Synopsys to capitalize on growing demand for advanced chip design tools across various sectors, bolstering its long-term growth prospects. The semiconductor industry is experiencing a surge in demand that extends across various sectors beyond just IT and traditional electronics. This growing demand for semiconductor chip is underpinned by several secular trends. For instance, the automation industry is undergoing a transformation with the advent of EVs and, more notably, fully autonomous driving vehicles. These advancements will necessitate a substantial increase in numbers and sophistications of chip to power the complex system required for autonomous driving capabilities. Similarly, data centers are consistently evolving to handle vast amounts of data, driving the need for powerful, efficient, and specialized chips to support their operations. Industrial robotics is another sector witnessing significant growth and complexity. As industries increasingly adopt automation and robotics, there will be a rising demand for advanced chips that can handle interactive tasks and facilitate seamless integration within complex robotic systems. Moreover, the aviation industry is embracing technology advancements with the development of next-generation aircrafts that will rely heavily on advanced semiconductor chips for navigation, communication, and crucial functions. Additionally, the proliferation of autonomous electronic systems such as AI-powered robotics and other smart devices will provide the demand for sophisticated chips capable of supporting these autonomous functionalities. It's essential to recognize that the efficiency of electronic system in real-world application isn't solely dependent on chip design. Ensuring that these systems operate seamlessly in real-world environments require comprehensive testing and simulation. In this context, Ansys stands out as a market leader in providing physics simulations and analysis software tailored for a wide range of applications, including chip design, manufacturing, automation systems, aircraft, and industrial equipment. Many designers and engineers rely on Ansys software to simulate and validate their electronic system before transitioning to mass production, highlighting the crucial role it plays in the assurance, the reliability, and performance of these advanced chips. Following the acquisition of Ansys, Synopsys aims to diversify its reach into various industry sectors like aerospace, defense, automation, and industrial fields. Ansys already boasts a substantial customer base in these industries. Acquiring Ansys is expected to provide Synopsys with the ample opportunities for cross-selling its products and services across these new sectors. In the upcoming year, based on market research, the EDA market is projected to expand 8.8% annually from 2023 to 2030. This growth aligns with Synopsys' own prediction. Furthermore, Synopsys anticipate that its total addressable market will increase approximately by 11% yearly in the substantial exponential subsequent years following the acquisition of Ansys. The increasing adoption of AI and machine learning techniques with EDA tech tools in another significant driver. These advanced technology helps address complex design issues more effectively and can also contribute to cost reduction, further fueling the demand for EDA software. Based on the consensus revenue forecast from Seeking Alpha indicates that Synopsys revenue is anticipated to grow by approximately 12% to 13% annually in the upcoming years. This growth aligns with the expected expansion rates of total addressable market mentioned earlier. It's worth noting that these consensus revenue projections likely do not yet incorporate the impact of Ansys acquisition. As of this video's creation, this combined revenue of Synopsys and Ansys stands at approximately $8 billion. Upon completing the acquisition of Ansys in 2025, Synopsys annual revenue is expected to increase by about $2 billion or more. Regarding earnings per share, consensus forecast suggests that Synopsys EPS growth will accelerate, ranging from the mid-teens to as high as 20% annually over the next few years. So let's calculate Synopsys stock's intrinsic value. So my first assumption is that the FCF growth rate to be 28.5 and perpetual rate of 4, and my discount rate is 9.2%. So once we calculate the first value to be around $433, I believe it's to be on the conservative side. And then let's look at the mid number. So my mid range is 34.5 at a perpetual rate of 4, discount rate of 9.2, and I believe the fair value to be around $538.99. So let's look at on the high side 40. Based on that, the fair value to be around $653.69. Let's look at Synopsys fundamental analysis by S&P Global Market and how it rates it overall. So one of their metric is under the valuation. The valuation metric combines fundamental data to determine if a company is overvalued or undervalued in its relation to its peer. From the looks of it, it is at a fair value. And under the quality metric, which uses fundamental data to assess a company's overall earnings quality in its relation to its peer, the metric uses information across all financial statements on the firm. As shown in the quality of the business, it is great and growing strongly. As for its growth stability, which is an assessment of how stable the growth of earnings and cash flow has been over the time, as you can see, it's less than 50%, which doesn't look that great. And that goes with the financial health as well, which uses fundamental data to view the company's debt and interest obligation. Once Synopsys takes on Ansys, which might not look that great for their financial health. Will I buy Synopsys stock? Yes, I will likely buy more shares of Synopsys in the future, particularly when its valuation becomes more attractive. And here are the several reasons why I support this decision. So it has a robust business model. So Synopsys possesses one of the stronger business models in the semiconductor industry. Unlike the overall semiconductor sector, the Synopsys isn't cyclical. Approximately 80% of its revenue comes from recurring sources, a trend expected to persist even after acquiring Ansys. It is also a leader in the EDA market. Synopsys holds a dominant position in the EDA market, which essentially makes up of 3 major players. Not only is Synopsys the EDA market leader, but also is the second largest IP vendor following ARM's holding. The high barrier to entry makes it challenging for new competitors to emerge in this space. Thing to note is the essential tool for semiconductor industry. Synopsys EDA software and IPs are indispensable tools for semiconductor companies, chip designers, chip foundries, and various high-tech firms. They rely on these tools for designing and verifying their chips. Another potential growth in semiconductor demand in AI to consider, I anticipate that Synopsys will significantly benefit from increasing demand for semiconductor chips, as well as advancements in generative AI and potential breakthrough in artificial intelligence or AGI. I believe we're still in the early stages of AI development. Given these factors, I see promising prospect for Synopsys in the evolving landscape of semiconductor and AI industries. These insights are solely my opinions and conclusions drawn from my personal research, and they should not be considered financial advice. Investing always comes with inherent risks. It's crucial to invest in areas you understand rather than speculating. Before making any investment decisions, I strongly advise conducting your own research and thorough due diligence. We'll include all the relevant links to the research that supports this analysis. Thank you for watching and supporting the Research on Investment channels, and I look forward to seeing you in the next video. Thank you.